People often confuse tokenization and liquidity.
So if tokenization scales, who benefits first?
We actually forced the capital market to accept blockchain and then use that to show the power of it. Overall posture from regulatory bodies around tokenization is not 100% clear. I think that a lot of these announcements are just sort of headlines and chest beating. All of the Y Combinator companies that have been successful focused on a serious problem. And so the equity market is relatively liquid.
Hey everyone, welcome back to another episode of Wrap Up Podcast. Today I have an incredible guest. I'm joined by Michael Tannenbaum, CEO of a Figure. Everyone talks about tokenization, Michael, as it's inevitable. But the real question, I think, is what needs to change for markets to actually move on chain? It's great to have you on the show, Michael.
Thanks for having me, Sam. I'm excited to be here.
Michael, when people talk about tokenization today, what do you think they are getting wrong? Because from outside, it often sounds like everything is easy. We're just putting assets on blockchain, but actually changing how markets work, in my opinion, is quite difficult, right?
Right. People often confuse tokenization and liquidity, or they sometimes think that, oh, we'll just put this sort of esoteric, not in demand asset on blockchain and that'll solve our problem. But it doesn't really work like that.
Right.
And a lot of times people are, when I have conversations, especially with people outside the industry or people who are interested in Figure, they might have something like, this is a real example, like a few warehouses in Costa Rica that they want to tokenize. Someone came to me with that. And it was, I think his intentions were good, but what I said is the amount of capital that's on blockchain or in stablecoin is significantly less than is not. So there's actually fewer people that are interested in a warehouse in Costa Rica on stablecoin than there are not on stablecoin. So that's not a good asset for tokenization. I think tokenization is useful when you're thinking about what are barriers that exist in the current financial ecosystem that don't make sense. Middlemen that are extracting economics or rents, and instead, how do we remove them and remove the friction and standardize assets and then tokenize those? So, of course, Figure's been a leader in that in the mortgage space. We've moved on to the auto space. We're moving into the equity space, right? But in general, the approach that we take is using blockchain to reduce friction and homogenize and standardize and get liquidity. But you have to have something that is homogenizable and standardizable before you do that. And warehouses in Costa Rica are relatively esoteric or idiosyncratic, right?
Right. And if we talk about friction, you just mentioned that. What do you think? Who creates that friction? Or I would say, what's the real bottleneck today? Is it like settlement, custody, or liquidity, or is it something else?
I'll use the mortgage space as my first example here. There's a long history of non-bank origination for consumer credit, mortgage, auto, personal loans, right? Lots of non-banks will make these loans. And in general, the loans are relatively similar, right? There's a credit score, there's a borrower, that borrower has income, borrower uses the income to pay off debts. However, the way the market has evolved outside of banks, because banks don't sell loans, so it doesn't matter. But when people sell loans, is every non-bank originator of these loans has their own credit policy, their own technology stack, and then they do their own what's called capital markets, which is essentially where they sell their loans to, because most of these people, since they're non-banks, they have to sell the loans because they can't keep them. They don't have that balance sheet. And so if you're buying these loans, you're doing that on a one-on-one bespoke basis with every single person. So let's just say someone like as an example, I used to work at a company, Brex. They did corporate credit cards, and there's also a company, Ramp, that does corporate credit cards. And roughly the way that they do them from a underwriting standpoint is similar. They underwrite the business based on the cash, but there is no liquidity between those two things, even though there should be, because they're roughly the same. So obviously both Brex and Ramp, their product is different. They're doing different sales. Their focused on building out that product and building out that sales and marketing. But from an underwriting and asset standpoint, it's relatively the same. And it would be much more efficient if it was all done on one sort of platform and tradable, because you could
Okay.
aggregate. And then when you aggregate and own more of something, it's much more efficient as a investor
Mm,
because you get more scale and you have more predictability that these assets are coming, and you can do things like get that asset production rated and securitize it and just bring it to bigger insurance companies and pensions funds. And so it starts to be really efficient if you standardize that across multiple things. So that's what
yeah.
Figure has done in mortgage, and that's
Okay.
what we're now doing in auto. And we're basically saying that you can use the blockchain to kind of immutably place the attributes of the loan up front on a blockchain and track the movement of these loans on a blockchain, and
All
also
right.
standardize the production on a blockchain as you do so.
Well, look, if it say tokenization is real, then what actual problem it's solving? How would you define that?
The problem it's solving is one, that there is a lot of third party due diligence and transaction costs associated with loans moving throughout the capital markets. That's at least
Okay.
in our case one of the problems.
Yeah.
Another problem that we're solving is the problem that people can double pledge the loans and commit fraud. And so
All
that's been
right.
a huge issue recently with Tricolor and auto bankruptcy. There was another bankruptcy called First Brands, and there was a third in England called MFS, where essentially people that originated loans were double pledging those loans in
Mm,
in the case of malfeasance. And without a blockchain, there's no way to know that the loan, you're given an Excel file and a piece of paper that says you have this loan. Somebody else
okay.
evidently was given that same Excel file and piece of paper. So that whole paper-based system is much less efficient than using
Okay.
a blockchain. So that's another example.
All
And then
right.
the last is just on lien perfection, right? So when you know that you have perfection into the lien. So, as an example, with an auto
Yeah.
loan or a home loan, if the lien on that piece of collateral is
All right.
registered on the blockchain, you know you have that. And that certainty allows you to have better leverage
Okay.
and potentially even cross collateralize it into other asset classes because you have the perfection and the confidence and therefore an easier ability to liquidate.
Right. Michael, you talking about a lot. You are talking a lot about blockchain because, like, when we talk about tokenizations, like basically they are, I mean, related to one another. So,
Right.
since we have blockchain, we understand that traditional rails are inefficient. I mean, they have been inefficient for decades. So you just highlighted this. Yet, those rails have not meaningfully changed. I mean, in the past decade. So why do you think this is the case? Is it because like the system works well enough and people like it, or that there are other reasons for that?
From the figure standpoint, we did something very interesting, which is we went after the home equity opportunity in the United
Okay.
States with the goal of showing people the power of blockchain. So it was a little
All
bit
right.
of a Trojan horse in the sense that we started with an asset class that was really attractive, relatively high rate, but also booming as home prices have gone up in the United States and rates have gone up. There's been a lot of interest in home equity, and by doing this really attractive home equity asset on a blockchain, we actually forced the capital market to accept blockchain and then use that to show the power of it. So, as an example, investors that wanted to buy our loans found were interested because they offered attractive risk adjusted returns. Then we
Okay.
showed them, hey, the servicing data is more transparent, you get paid faster with faster settlement, you have confidence that the loans aren't double pledged, and we actually changed the buying criteria. So now people want assets on blockchain even though initially they just wanted the high quality assets that we offered. So it was a very purposeful kind of marketplace oriented approach that helped people see the value of blockchain in the capital markets.
Yeah, it's really interesting. And now I want to talk about figures specifically. So when people think about tokenization, again, they jump straight to equities, but you guys started with credit. And why was the entry point credit, not something else like equities?
Well, I think the background of the company was born out of SoFi, right?
Okay.
Where I was the chief revenue officer, the founder of Figure, Mike Cagney, was the CEO.
All
And
right.
at that time, we were originating almost $1.5 billion of loans a month. And as a result, we had to think each month, well, where do all these loans go and how there was so much third party diligence being done, and we were paying all these firms to check everything multiple times each time the loan moved from, say, a warehouse line to a securitization to a buyer. And so there had to be a better way. And so that was the experience of the company, and that's why loans, at least in our case, was the early start. But
I see.
ultimately, the concept of bringing the capital markets on chain is one that extends beyond just consumer credit or even loans to equities, commodities, prediction markets, et cetera. I mean, prediction markets is more of a way to trade things, but yes.
Yeah, yeah. It seems like it was like you guys saw a real problem from your past experience and you moved in this direction. But also, do you believe that credit simply a more open market to rebuild? That's why you started there, or again, it's simply because you saw the potential there.
I think it's a combination of experience in the space, but also look, there's been a lot of focus on equity tokenization because equities are sexy,
Yeah.
but at the same time, fixed income is the more obvious initial opportunity because you have more similarities but yet less liquidity. And even though the stocks of different companies are actually quite varied, right? There's very little in common among the companies that have stock. For example, Coca Cola is very different than, say, a biotech stock that just IPO'd, but there's lots of liquidity in trading in all these stocks. Whereas for debt, even though an auto loan to someone in New Jersey with a 700 FICO is very similar to one in
Mm,
California with also a 700 FICO and similar income. There's no liquidity or homogeneity between those two prior to something like Figure. And so the opportunity is actually more obvious in debt in that
okay.
way. But at the same time, I think because equity is just understood better by more people is probably why you've seen more efforts there. Although we, of
Yeah.
course, have our own efforts in equity too.
Especially with neo brokers and neo banks like Robinhood, they are all like jumping into tokenizing equities, as you said, because again, maybe it's easier to understand and more liquidity. So here's the next question. I mean, what did you learn from tokenizing lending that applies to broader capital markets? Can you share your experience?
The value of, I think, the interest in removing the middlemen is a big one, right? In a way that
Okay.
benefits everyone. I think there's lots of people in the value chain for loans that
All right.
extract rent in different ways. And by removing them, you can sort of increase the economics and ownership for the people that do most of the work.
Okay.
And sometimes I like to say what we've done is for asset ownership and origination, the same that the internet did for content creation, right? That's what blockchain
Okay.
does. So
Very
it
interesting.
really kind of turns power over to the originators or the content creators. And
Right.
that is kind of the same thing that applies to equity, which is right now issuers in equity, meaning the companies that actually represent the equity, don't have a lot of control or ownership of the economics that accrue to equity, right? So just as Figure, we're a public company, we can't even see who actually owns our stock. We don't know
Right.
at any time who owns it. It's all intermediated between brokers and people. The stock is held in the name of the brokerage firm, so we
Right.
actually have no idea who owns the stock. We get information much later through SEC filings. We can't communicate directly with shareholders. So, this idea of kind of turning the power over to the equity issuer is very similar to how we turn the power over to the loan originator, like we did in debt.
Right. Michael, since you guys are removing, let's say, a number of players, number of middlemen when you move everything on chain, did you get some sort of a pushback from the market saying like, no, we don't want this, there are issues here and there? Because again, let's say if I was one of those middlemen, I wouldn't like to lose my business, since since you moving like everything on chain.
Absolutely. One of the challenges of disrupting in financial services is that it is a market with relatively sophisticated people that are relatively highly paid. You think
Yeah.
about, for example, when Uber or Airbnb emerged, they were disrupting taxi drivers and bed and breakfast owners. Not that those
Yeah.
people, they are valuable people, but
Yeah.
I think the money and the sophistication behind that industry is much different than what you see behind financial services. And so, yes, it is more of a challenge. And I think that one of the things that Figure did was innovate around a niche like home equity, which was relatively abandoned by that industry. And you have that classic disruptive approach where disruption starts at the bottom. And so if you look at where Figure's been most successful, it's
Yeah.
been in the smaller balance mortgages. Our average is around 100,000. Today, most of the financial services industry doesn't care about those because they're too expensive to originate. But we have cut so much cost out of the origination process. We actually do a mortgage in $1,000 versus industry average of 12. And so we're really disrupting at the bottom of the market. And right now, there's not, that isn't on the radar of the incumbents as much.
Right. Um, Michael, look, when we talk about tokenization, in my opinion, you mentioned this, for example, tokenizing equity is sexy because everyone understands, and maybe there is already equity exists, and you just need to put it on blockchain. But there is also a new term that I found out: blockchain native assets. So, what's the difference between a tokenized asset and a blockchain native asset? How would you define that?
Equity is a good place to look into that, as would be debt. I
Yeah,
think the difference is, so when Figure did our equity offering, we actually created a new share class that was native to blockchain and therefore doesn't require the middlemen like DTCC or
yeah,
the introducing and clearing brokers, because it's a new share class that can trade in its own way and isn't
yeah,
subject to the same rules and processes as would be a traditional equity. Whereas
right,
what a lot of times you see with other tokenization efforts is they take a existing security, kind of put it in a box somewhere, chop it up, and say, okay, we've
right,
like fractionalized it, and then you can sort of trade this fractionalized version, but it looks back to whatever's happening in that box, and
yeah,
that's a trust based process that requires you to ultimately trust whoever put that kind of equity in the box, and
okay,
that is very antithetical to what blockchain is supposed to be about, which is a permissionless and truth based process. And
yeah,
that's why I think the native approach makes more sense. The same concept would apply to a loan, where you want the loan and its attributes originated native to chain, rather than say, okay, I'm going to assume that this person did the loan properly and then subsequently puts the loan on a blockchain, but you still don't know about all the issues before it got on the blockchain. So the important part is minting that loan at the time of origination and putting those attributes of that loan on the blockchain up front.
I see. I see. That makes sense. Now, that clarifies a lot of things, at least personally for me. And
Sam,
Michael, I
I'm here
want
to
to get,
clarify.
yeah, I want to get you one more thing. I want to get your opinion on one more thing. I want to connect this to what's happening right now in the market. We are seeing a lot of incumbents move. For example, New York Stock Exchange, they recently partnered up with Securitize, to support tokenized securities. So market is paying attention to this. And how would you interpret this move by, for example, New York Stock Exchange?
Clearly, tokenization has taken over the conversation about the future of financial services. A year ago, if you were in a board meeting and we're talking about tokenization, people would probably look at you funny. Whereas now, every company that's associated with financial services has to have a tokenization strategy. And I think it's a positive that you see so many different efforts from the incumbents to build plans for tokenization. However, I think that a lot of these announcements are just sort of headlines and chest beating. Whereas you look
Okay.
at Figure, we're basically 75% market share in real world asset tokenization. And I think we have the right to win in this space.
Okay. In that case, would you say these guys are just trying to shape the, well, you said like they are just beating their chest and this is just words. In that case, you would you say like only you guys are doing some meaningful work, or we still are seeing the guys doing something in the background? Again, I will go back to example of New York Stock Exchange. I mean, is it just a word, or should we expect something meaningful out of this in a like a near term, in your opinion?
Look, as of today, Figure is the only party who has done a tokenized equity transaction in the public markets, with a publicly available security that people can buy and has liquidity. I welcome, efforts across the industry. I'm just simply saying within blockchain tokenization, not just for equity, but in general, there's
All
been
right.
years of chest beating and headlines, but at the end of the day, Figure has 75% market share in that activity. And that's because we use tokenization and blockchain to actually add value by lowering costs and removing middlemen in a way that benefits everyone.
Okay, I see. When we talk again about tokenization, it seems like there are two paths. One is where tokenization is layered basically on existing infrastructure, and one where it replaces it entirely. What do you think? Which one actually wins?
Ultimately, it will replace the legacy infrastructure, but there will be a period of time, and we're in that period of time where they're working side by side. However, the benefits ultimately will bring people to the tokenized version of the capital markets.
Okay, I see. Well, the next important question, I think, whenever infra change, it comes down to incentives. Basically, everyone wants to understand this. So if tokenization scales, who benefits first? Is it, I mean, issuer, investor, asset manager? Who's that?
Similar to the example I gave with the internet and how it ultimately benefited both the consumers and the content creators, but it
Okay.
put pressure on the people in the middle. I think it's similar in tokenization. You have investors on one side and you have issuers on the other, and both benefit from this. But in the middle, there's lots of parties that extract rent, whether that be kind of people that temporarily buy loans and then sell them or securitize them, but don't ultimately own that security in perpetuity in the loan space, or whether it be people in the equity space that focus on custody or brokerage, prime brokers, all those types of people that kind of make their business in the middle. I
Okay.
think that's going to get squeezed by tokenization, similar to how the internet squeezed a lot of the publishers and the distribution, and then
Mm.
kind of and then return power on both ends to the market.
All right, I see. Michael, tokenization model sounds really good. It sounds better in some places in practice, in some places in theory. But so far, it seems to me the adoption is slow. How do you solve the cold start problem?
The example that I gave with what Figure did in home equity, I think is a
Okay,
perfect example. And so you also you have to look at what I call hair on fire problems, right?
okay.
Where is someone's hair on fire? And so what you had in the past couple of years in home equity was 35 trillion of home equity, lots of people with uh, mortgages that were in the money, and so people wanted to take out home equity loans on top of that, and Figure made that really easy and used blockchain to do it. Now in equity, I think there's a few examples where it would be really powerful to have a tokenized approach. One is where there's lots of short interest, because when you have a lot of people shorting your stock, someone's
Okay.
making a lot of money on that borrow, but it's the prime broker. And if you're an
Yeah.
issuer, you obviously don't like people shorting your stock and you prefer your investors to accrue those economics. So you should say move to the blockchain and let your investors own the upside in all the people that want to borrow the stock for shorting it. And so you can acknowledge that reality. That is a hair on fire problem. I think digital asset treasury companies, DATs, that are trading below NAV have a hair on fire problem. If they move to the blockchain, they can actually distribute out the underlying token or treasury to kind of close the gap between net asset value and the share price. And
All
that's
right.
another example. So I think you have to focus on these quote, and this is how any disruption happens, right? All of the Y Combinator companies that have been successful focused on a serious problem. They didn't
Mm,
give technology for technology's sake. Nobody signed up for the early payroll softwares because they wanted to use technology. It's because they had a problem paying people, right? And so
yeah.
I think people sometimes miss this with blockchain. It's technology, and you need to focus on the uses of it, not the technology itself.
Yeah, no, it's a good analogy. I really like it. But one thing I have to highlight in this point, when we talk about blockchain or disruption, we cannot go without regulation. So again, some people say regulation is the blocker. Some say it will follow as you grow. So what's the reality at the moment with the regulation?
For Figure, the reality's been that we have survived and thrived in multiple regulatory environments. We've been doing what we've done both prior to the Trump administration. We've obviously benefited from some of the tailwinds that have come. But I think stablecoin's an interesting example. We
Yeah.
have something called yields, YLDS, that is an SEC registered security that acts as a tokenized money market fund but is peer-to-peer transferable. We got that
Okay.
approved in the Biden administration, and we used existing regulatory frameworks prior to the Genius Act to build that stablecoin. And now, depending on what happens with clarity, right, it will be one of the few, if not the only, stablecoin that is peer-to-peer transferable that also can offer yield. So I think that's a perfect example of us doing this. Similarly, in the mortgage space, we're directly regulated by the 50 states. We have those mortgage licenses. We have money transmission licenses,
Okay.
and we've been doing this activity on blockchain for years, since 2018, and
Okay.
the environment for crypto was much more hostile for most of that. And so that's my thought is you never know how the government regime is going to be in terms of blockchain. Of course, we
Right.
went public recently, and we were helped by some of those tailwinds, but we're also sober to the fact that these things can change.
And I saw that you guys also issued your stock on chain. And how do you like the results so far? What was the demand like?
We did a solid offering across
Yeah.
multiple institutional investors as well as retail, and
Okay.
we was oversubscribed. So we're feeling good about that early win. I think it was really important to get that transaction out there. And if you kind of go back to our early days in mortgage, first transaction was by no means perfect, but the important thing is getting it done, showing that there is a blueprint, and then
Okay.
continuing to grow and improve on that initial first step.
All right. I see. Michael, I will go back to regulatory issues again. So, what do you think? What are the main constraints at the moment from regulatory perspective? I mean, yeah, everything's going good. We see positive trend, but still there are some regulatory constraints. What are those in your opinion?
I think clarification around DeFi, which is still um, something that could be enhanced from a regulatory perspective, what constitutes a security and what doesn't. And in general, I think the overall posture from the regulatory bodies around tokenization in particular is not 100% clear. It
Mm,
right now, I think there's been some like no action letters and things like that, but there is not necessarily as much of a framework for how tokenization can work across all the different asset classes.
I see. And My closing question would be, Michael, if Figure is right about tokenization and it becomes part of the market infrastructure, what does the system would look like in a 5, 10 years, in your opinion?
It's going to be a much faster, more seamless approach to both issuance and origination as well as ownership. This is an area where the intersection between AI and blockchain is really manifest. And you can imagine kind of agentic asset allocators for people and individuals seamlessly accessing multiple different asset classes, trading and borrowing between them in a way that optimizes whatever goal is needed. And
Okay.
similarly, on the origination side, hooking up the basic processes that an originator has to do, like verify identity, verify income, verify value of whatever collateral there is. And those will be agentic as well, but come
Okay.
with a blockchain based capital market. And you can imagine a much more transparent, less people intensive, but richer process that ultimately brings better outcomes for those originators and for those investors. So, kind of playing that forward.
Right. Michael, this was a great conversation, and thanks again for joining the show.
Thank you for having me.